Hey, good morning once again, options traders. Well, it's time to move into some more advanced topics. Recently, I talked about a second-tier Greek called Vama, and I mentioned that there is really quite a long list of these second-tier. Sometimes we call them a second tier because they're not the main Greeks. They're like a subcategory. Doesn't really mean that they're less important, but they're not the ones that most people are familiar with. And in that list is one called charm. So what is that? Well, before we get started, as always, please click like, and while you're at it, please click subscribe. It does go a long way into promoting the channel. So remember what all of these first tier and second tier types of risk measures are. They're all part of our Greeks. And in the first tier, we have delta, gamma, theta, vega, and rho. And there are videos in this forum talking about each of these individually. So if these are not familiar to you, you might want to check those out as well. But then there's this subcategory, again, called the second tier Greeks. And in that list is charm. So what is charm? Charm is sometimes called T delta. And what that means is that it is the effect of time on delta. So that first letter T, that's the variable that we're moving, time. And how is it affecting delta? So you might also hear it called T delta. So charm is the sensitivity of delta relative to time. So in a similar way, you're familiar with theta. That's usually what comes to most traders' mind when they hear about the passage of time affecting an option. They always think about theta. And it works in a similar way. Theta shows the option's price sensitivity as time passes. So maybe it's a $3 option, then it falls to $2.90 and so on. It keeps getting less and less valuable as time goes on until it eventually hits zero. That's assuming that it stays at the money. Well, as time passes, all of your Greeks change. And in fact, all of your Greeks change all of the time for various types of variables, unless you start getting either super deep in the money or right at expiration. But for the most part, they are always changing. And so delta is going to change with the passage of time as well. So that's what we're trying to figure out. How does delta change? Well, there's some easy ways to think about it. First off, at the money, your delta remains near the same as time passes. Not exactly, but for practical purposes, it's going to stay about the same, but it's actually going to lose a little bit of delta as time passes. But it's going to be drifting near a delta of 50. For your out-of-the-money options, however, delta falls toward zero. So it's going to start at a higher number, and if it's an out-of-the-money option, it's going to eventually drift towards zero. That's assuming that the stock price doesn't change. For an in-the-money option, it's just the opposite. Your delta rises towards 1.0 or towards 100. So it's going to start with a higher number than a half because it's in the money, and it's only going to become a higher and higher delta as time passes. Again, that's assuming that the stock price stays the same. That's what it means whenever we say, what's the effect of time? We're just letting time move. We're keeping everything else the same. So this can sometimes be a difficult concept to understand, but I talked about this one recently, this example with a time clock in any kind of a sports game, and it really goes a long way into understanding charm. And if you just remember that delta is the approximate probability for the option to expire in the money, and that will help you to see what's going to happen as time passes and also why. So take a look at this. We saw this recently with the Super Bowl for 2022. Final score was 20-23. But let's say that this is at the half. And if it were at the half and you had to be the odds maker, you might say, well, it's pretty close to a coin toss. But if I had to guess, I would have to give a little bit of an edge to the Rams because they've got a 3-point edge right now. So maybe I'm going to say there's a 55% chance for the Rams to win, and therefore a 45% chance for the Bengals. And if these were options, that's exactly what's happening. We would see a 55 delta on the Rams. We would see a 45 delta on the Bengals, or in this case, whatever these calls and puts happen to be. So if the call option is in the money a little bit, let's say it has a 55 delta, The corresponding put, meaning the same strike put, would have a 45 delta. Technically a negative 45, but we just ignore that negative sign. Those two deltas have to add up to 100%. So let's say that some time goes by and we're getting closer and closer to the end of the game. We might say, you know what, it's still 20 to 23. Remember, we're keeping everything else constant. And what's going to happen to your assessment? Well, eventually you'll hit a point where you might say, well, now I'm 70% certain that the Rams will win, and therefore 30% certain for the Bengals. And that would be the same as saying there's a 70% chance for this call option to expire in the money, therefore it's got a 70 delta, and a 30% chance for the corresponding put to be in the money, so it's got a 30 delta. But now let's say some more time passes. Eventually you will reach a point where you might say, I'm 90% certain that the Rams will win, and therefore only 10% certain that the Bengals will win. And so that would be like saying this call option now has a 90 delta. There's a 90% chance that it's going to expire in the money, and therefore the corresponding put option only has a 10 delta. So again, 90 plus 10 adds up to 100. What happens as you get closer and closer, eventually hitting those final seconds of the game, you will say, okay, I'm now 100% certain that the Rams have won, and therefore there's a 0% chance for the Bengals to win. And at that point, that in-the-money call option will have a delta of 1, and that out-of-the-money put option will have a delta of 0. So here's what it looks like graphically. So let's start with the at-the-money, and first of all, we're looking at the effective time. So here's 45 days to expiration, and here's 0. On the vertical, we've got deltas. So notice that this black line for the at-the-money option is reasonably flat. It's not perfectly flat. If you were to zoom in here, this might be a 52 or 53 delta. And then down here, it's going to be pretty much exactly 50. But it's pretty close to just a flat line. But now let's take a look at the in-the-money options. And I'm just looking at the call options here. And so if it's an in-the-money strike, it's going to have a delta higher than 50. And that's why this green line over here sits above the black. So it might be starting off with a delta of 55 or 60. But as time passes and we start moving this way, look what's happening to those deltas. The market's becoming more and more confident that that option's going to expire in the money until that expiration bell rings, at which point we're saying, okay, it's definitely a delta of 1. And we know it now because it's expired with intrinsic value. What about the out-of-the-monies? If we had an out-of-the-money call, it's going to start out here. It might have a delta of 30 or 35. It's going to be much less than 50. But as time passes, it starts to lose some deltas. And eventually it does this, and it goes right down to 0. Because it's still an out-of-the-money option, but because there's no time until expiration, now we know for sure there's no way it can be an in-the-money option. See, when there's time remaining out here, even though it's an out-of-the-money option, there's still some chance for it to move in the money. That's like saying your football team is behind, but hey, if it's just the first quarter, there's a lot of time for them to come from behind. And so you still might give them a fairly high probability of winning. But as that time starts going towards 0, your confidence, or in options trading terms, your delta, has to start moving toward 0. So if you have an in-the-money option, it's going to appreciate towards delta 1. Or if you go in this direction and start going to longer dated options that are in the money, they're going to start losing deltas. So maybe you've got a 6-month option that's got a delta of 0.8, and you go out to a 1 year or a 1.5 year option, same strike, it's going to have a lower delta for this very reason. So that's really what Charm is showing you. Now, most of your broker's platforms are not going to show that to you. You can back into it by using a pricing model. You could certainly figure it out. But the important thing is to understand how these deltas are going to either appreciate or depreciate over time. That's what's most important, because a lot of times new traders think, hey, I just bought a 70 delta call and therefore it's always going to be 70. That is not true. Even if the stock price stays the same, the passage of time is going to change your deltas. And that's something you must be aware of, as well as the direction. Are they going to appreciate towards 1 or decay towards 0? And if you understand those basic movements, it will go a long way into helping you understand how certain strategies will work. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsa2z.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.